Welcome to the Financial Markets Insights podcast, brought to you by the Realization Group, where we bring together the best minds in the financial and capital markets industry to discuss all the latest trends and news. Our podcast host today is Jana Pache. In episode 5, we will be examining central bank digital currencies, or CBDCs. What are they, and what impact may they have on the future of finance? Our guest speaker today is Jake Hartley of Finality International, a company which is using distributed ledger technology to create a peer-to-peer wholesale settlement ecosystem.
Central bank digital currencies, or CBDCs, are undoubtedly a hot topic. Midway through 2021, it's fair to say that not a week goes by without news from at least one central bank of their latest plans for tests, pilots, and live trials. In the UK, Rishi Sunak's announcement on the 19th of April this year of a joint HMT and Bank of England task force to coordinate exploratory work on a potential central bank digital currency has led to a range of reactions from the media. Excitement, bewilderment, confusion, a misguided perception that the UK is about to create its own cryptocurrency, and a heartfelt plea of, could someone please explain what this all means for us, being foremost amongst these. For financial markets participants, it's particularly important to understand the potential for CBDC to transform the ways in which wholesale payments are made and the potential opportunities for innovation and evolution of financial markets. Let's start with the basics. What is a CBDC and how does it differ from the digital forms of money that we have today? Isn't money already effectively digital, given the increasing move to a cashless society and the advanced state of electronic interbank payments? The answer is yes, with a few caveats. The digital payments infrastructure that we have today has been evolved incrementally over many decades, and many of the design features underpinning that infrastructure embody technological constraints at a point in time. The principle behind CBDC is that it is digital native. It's designed to meet the requirements of a modern and increasingly digital economy, and it can be implemented using frontier technologies that enable these requirements to be fulfilled. CBDCs are often associated with distributed ledger technology, DLT or blockchain, and this has led to frequent misunderstanding in the media around their relationship to cryptocurrencies. A CBDC is not a cryptocurrency. It is a central bank issued digital native form of fiat currency. Whilst many CBDC pilots around the world are being built on DLT, it certainly isn't a prerequisite, and some are being built on more traditional architecture. Stablecoins, such as JPM Coin, or the most famous of them all, Facebook's Diem, are tokenized forms of e-money that can fulfill similar functions to CBDCs, but are issued by private firms and therefore retain an element of counterparty risk exposure that isn't present with CBDCs. A distinction is usually drawn between wholesale and retail CBDCs. These aren't necessarily different types of CBDC as such, although some countries might choose to implement them differently. Rather, they refer to the primary use cases for which the CBDC is intended and may involve different delivery channels, payment systems, or payment intermediaries. Retail transactions are those undertaken by individuals or businesses for everyday payments purposes. Wholesale transactions occur between financial institutions, such as banks, to settle their liabilities to each other. There are overlaps between the two as well, as retail payments may give rise to wholesale settlements being required between two banks, for example. So, what can we do with CBDC in the wholesale markets that we couldn't do before? Like other forms of digital money, including stablecoins, CBDCs can be used to make payments more efficient and reduce friction at a fraction of the cost. This has great potential for cross-border payments in particular, given the current fragmented nature of payment systems globally and the high degree of intermediation required, providing that a means can be found to implement interoperability between different CBDCs. In financial markets, it also has the potential to make security settlements more efficient. A more streamlined, fast, and efficient payments process will lead to obvious savings in operational costs. We can go one step beyond this as well, looking to the future of digital assets and securities. We are now seeing the development of tokenized digital native forms of traditional securities, which can be settled instantaneously, bypassing the need for layers of clearing and settlement infrastructure on a distributed ledger. These are implemented using smart contracts, which can automatically manage events and payments throughout the lifecycle of the instrument. However, instantaneous settlement of the securities leg of trade is rather meaningless in the absence of a capability for instantaneous settlement of the payments leg as well. Stablecoins can fill this gap, but lack the trust and systemic resilience of a central bank-backed form of digital currency, which would be the ideal solution to wholesale settlement on ledger and would enable the transition to fully digital capital markets. The Bank of England has made clear that no decision has yet been taken on whether the UK will have a CBDC. Nevertheless, it has been actively researching, consulting on, and experimenting with digital currency for a few years. A CBDC would also take time to implement and to realise its full benefits, to be interoperable with both existing payment systems and other CBDCs. In the meanwhile, private operators are powering ahead with stablecoins and innovative payment systems and laying the foundations for a truly digital economy. As these become more widely used, the bank and other regulators are acutely aware of the potential for systemic risk to arise and are working on strengthening the regulatory regime around these systemically important stablecoins. It's quite likely that, in the UK at least, the future of payments and settlements will involve a combination of private and public forms of digital money. Jake, it's great to have you here with us today, and thanks for joining us.
Hi, Jenna. Thanks for having me.
So tell us a little about yourself and your background.
Yeah, absolutely. So I work on commercial and business development at Finality, and I work closely with our shareholders, who are all major financial institutions, to drive the commercialization of the Finality proposition and the growth of our network. And prior to that, I was driving the commercial side of the blockchain proposition for PwC in the UK. I have a particular interest in CBDCs, not least because the Finality value proposition is all about seeking to facilitate many of the benefits and more for cross-border payments in the wholesale space that CBDCs also seek to achieve, namely increasing operational resilience, making risk management more transparent, and making processes more efficient. So that is to say, delighted to be here to talk about it.
That's great. And we will come back to the Finality proposition a little bit later in the podcast, and give you an opportunity to tell us a bit more about that. But to start off with, let's talk specifically about wholesale CBDC. What do you see as the biggest benefits of a wholesale CBDC? Is it primarily in terms of the potential for innovation? So, for example, in the supporting the evolution of digital asset markets, or is it a bit more prosaic in improving the way that cross-border payments and interbank settlements occur and things like that?
Yeah, I think the two areas that you mentioned are certainly the front runners, in my opinion. On cross-border payments, I think it might make sense to touch on an overview of the cross-border landscape as regards wholesale payments before getting into the case for CBDC in the area. CBDCs are ultimately just one way in which we might strengthen the cross-border payments landscape. But the question is, why would we want to do that for wholesale payments? Wholesale cross-border payments, for context, total just 20% of global transaction volume, but 80% of transaction value, because they're so vital in supporting world trade. So at a macro level, any solution to strengthen wholesale cross-border payments is primarily about financial stability. Enhanced capital and liquidity requirements have been imposed on banks since Basel III, but a significant part of the risks to financial stability stem not only from the type of assets that financial institutions hold, but from the ways in which they move them around, the ways in which they transact in them. And correspondent banking is one of the main methods for executing money transfers on a cross-border wholesale basis. And central banks refer to this as tiering, the idea that most banks don't transact with each other directly, but rather through money center banks acting as intermediaries. And this is effectively a highly complex and interdependent network of banks that unfortunately comes with multiple risks, like credit counterparty risk, FX risk, the availability of liquidity and the opportunity cost of misplaced intraday liquidity, a lack of real-time visibility as to the settlement status of a transaction. And to give an example of how that might look in practice, if one party defaults, this can create a chain reaction if the associated transactions aren't properly settled. And in addition to all of that, the availability of correspondent banking services is decreasing, increasing market reliance on fewer intermediary banks. And the main reason for that is increase in regulation and therefore cost, with the result being that the FSB have reported that almost half of all banks rely on no more than 2 correspondents for the majority of their cross-border traffic. So ultimately, the overarching objective of any future wholesale cross-border payment solutions, CBDCs or otherwise, is to increase trust between financial institutions around the world and to empower them to transact in a quicker, safer, and more transparent manner. Now, as illustrated by the fact that we're here today, CBDCs are one increasingly talked about innovation by which we might achieve this. And as many listeners will be aware, the discussion around CBDCs is primarily split between retail and wholesale. And the motivations for the issuance of a retail and wholesale CBDC are very different. Retail, on one hand, is centered around promoting financial inclusion, mitigating tax avoidance, reducing printing and handling costs, and move to a cashless society. Whereas on the wholesale side, it's primarily around making financial systems faster, cheaper and safer, reducing counterparty risk, reducing settlement times, and the provision of a digital cash asset of the highest order that unlocks the door to a broader ecosystem of use cases. And if we were to move to an application of CBDC, as you mentioned, in the wholesale sector with a digital representation of central bank money and wide cross-border use, exchangeable peer-to-peer on a same-day basis without settlement or credit risk, the reliance on traditional, self-evidently riskier methods of cross-border payments like correspondent banking can be dramatically reduced. And that would result in a wide range of benefits like faster settlement, reducing credit and counterparty risk. Naturally, the quicker the settlement, the less opportunity there is for your counterparty to default. Cheaper settlement, naturally, the removal of intermediaries will reduce cost, extended settlement hours, the direct linkage of securities and FX platforms to the cash platform, which would eliminate settlement risk. The list goes on. Increased system resilience as compared to centralized systems. So that's definitely the case for CBDC in the cross-border payment space. And I think that is one of the primary use cases that we should get very excited about. On the topic of digital assets, as you mentioned, new markets, particularly those in tokenized assets, will need payment rails for the payment leg of any DVP transaction. At the moment, there are myriad tokenized assets in existence and many exchanges on which to transact in them, as I'm sure we're aware. But an on-chain cash asset with the credit characteristics of central bank money is what's needed to fully unlock the potential of this novel asset class. In that sense, then it's perhaps something of a misnomer to say that digital asset markets are a benefit stemming from CBDC. There already exist several use cases for tokenized assets across securities, commodities, property, and other spaces, but without a high quality, credit risk free cash asset in which to transact in them, their viability and their uptake has remained quite niche, especially in the institutional space. So it's rather the digital asset markets themselves, in my opinion, that stand to benefit from a quality on-chain payment arrangement, be it CBDC or otherwise.
Thanks, Jake. That's super interesting. And I just want to go back to that really fascinating explanation that you gave about the state of the corresponding market, corresponding banking market, and what's going on there. And it sounds as though, you know, that there is now, due to enhanced regulatory requirements, this greater concentration on certain providers of correspondent banking services, and that leads to greater credit risk for everyone who's using them, and also and settlement risk as well, obviously, and also overall greater systemic risk in the payment space. And I guess if you're a central bank or a prudential regulator, then actually you've got a real interest in obviously, because it's part of your mandate, in preserving the integrity of the payments system and payments infrastructure. And so addressing this challenge is actually part of your core remits, and a good reason for looking at digital solutions, right?
For sure. I agree with every word of that, Jenna. Concentration and systemic risk is absolutely at the front of mind for particularly major advanced market economy central banks. And in every public consultation or webinar and the like, where these institutions have been talking about CBDC and the work that they've been doing on them, they certainly highlight that as one of the primary, if not the primary, rationales for pursuing it.
Well, we are also seeing, in the last few years, prior to or alongside many central banks starting to take an interest in CBDCs, we have started seeing programs such as RTGS Renewal, which are looking at modernizing and enhancing existing infrastructure. And to what extent do these fulfill some of those requirements that could be met by a CBDC as well? And also, I guess, to what extent would they preserve or require changes to the existing payments market infrastructure? Because it sounds as though a lot of the benefits that you cited for a CBDC would actually arise from significantly disrupting that existing payments infrastructure and its reliance on correspondent banking.
I think that, look, while CBDCs have experienced a surge of interest from central banks and observers alike, the majority of that interest has centered around retail CBDCs, designed for use by the general public rather than wholesale CBDCs designed specifically for payments and settlements in the wholesale sector. But despite several high-profile projects, think, Ubin, Jasper, Stellar, Helvetia, Lionrock, no wholesale CBDC project has yet gone live. And the rationale for that, I think, has been put quite well by the CPMI, where they said that currently proposed implementations of wholesale CBDCs look broadly similar to and not clearly superior to existing infrastructures. So I think it's clear then, exactly as you've alluded to there, the key question that central banks are asking as regards wholesale CBDC are, what are the core benefits of wholesale CBDC arrangements versus current state RTGS systems? And in the absence of sufficiently compelling answers to that question, the attention of central banks has shifted, I think, somewhat to the incorporation of features of the underlying technology, distributed ledger technology primarily, into their pending RTGS renewal programs, with the Bank of England being the most high profile investigator of that approach. And their conclusion in the event has been that they should place a high priority on ensuring that any new service is capable of interfacing with DLT solutions as and when they're developed. So to me, and you definitely mentioned this in the introduction earlier, the absence of any wholesale CBDC solution yet live indicates that public sector institutions may instead wish to avail themselves of certain features of private sector innovations that such solutions wouldn't otherwise possess if they were based on traditional design choices.
So CBDCs sound like pretty good solutions to a lot of problems, although as we have mentioned as well, there's a good case for central banks to look at their existing infrastructure and what can be done with that. What are the key barriers to central banks adopting wholesale CBDCs?
Well, to me, it's less about barriers to adoption and more a matter of major central banks really wishing to ensure that they get it right. As I said, it's likely that they recognize that there's value in collaboration with other innovative organizations in achieving the best outcomes and design choices possible. And I think that there's broad acceptance from everyone in the CBDC community that there are certain things that both sides, public and private, have a natural advantage for. Central banks obviously have a vital, totally indispensable role to play in bringing trust, stability, regulation to any CBDC initiative. And of course, that's not just an area in which they have an advantage. They're quite literally the only ones who can do it. There can't be a CBDC without a CB, and external actors must be prepared to innovate within their regulated framework. But on the other hand, there are certain areas that we might say the private sector has a natural advantage for, such as cross-border coordination or technological expertise, facilitating interoperability, maintaining the integrity of a DLT protocol. The list goes on. A directly issued wholesale CBDC, i.e. by a central bank acting alone, might find difficulty in leveraging any cross-currency use case, including multi-currency PVP, payment versus payment solutions, because different jurisdictions operate under different legal regimes, and agreeing on a coordinated system of oversight would certainly not be simple. And even in the domestic context, as well as cross-border, interoperability with other settlement systems for delivery versus payment use cases will face similar challenges. And if a CBDC system is to be DLT based, maintaining and coordinating a community of nodes and participants and ensuring the integrity of the protocol is maintained is very much outside the traditional expertise of central banks. So while I wouldn't call any of these things a barrier per se, they're certainly concerns, and there's still significant work to be done from a central bank point of view to ensure that they're achieving the best outcomes possible when they do adopt a CBDC arrangement or similar.
Okay, so you touched on interoperability there, and I guess there's two types of interoperability really that we can consider. The first is, as you mentioned earlier, between existing payment systems and CBDCs. So looking at how we can future-proof existing payment systems so that in future, if a CBDC does come along or some form of digital currency, that they are able to interoperate with each other, and so that we don't have these mutually exclusive payment rails existing alongside each other. And I guess from any user's perspective, it should be a seamless experience as well. So they shouldn't necessarily care whether it's, a transaction initiated on CBDC infrastructure or traditional infrastructure. There should be some way to flow between the two. But you've also mentioned interoperability between different jurisdictions. And I guess in order to fully realize the benefits associated with cross-border payments and things like that, there is going to need to be a level of interoperability. But how exactly do you go about implementing interoperability on that kind of global scale? Because I guess, for the domestic payments interoperability, that's within the gift of one single jurisdiction. But when we're looking at interoperability between different jurisdictions, are we looking at like common APIs? Are we looking at common standards? What are the actual potential solutions to that?
Yeah, absolutely. It's a tremendously important question, and interoperability is definitely essential to achieving the aims of a CBDC arrangement. One of the most interesting proposed solutions to the challenges of CBDC interoperability in recent months is known as multi-CBDC systems. And for the benefit of those listening who are perhaps not as familiar with the topic, it might be worth delving a little bit deeper into that terminology before kind of assessing the viability or lack thereof of it. As I was just saying, there's inherent difficulty in the capacity of wholesale CBDCs that are designed and issued independently by individual central banks to leverage cross-border use cases as a coordinated system of oversight around these divergent instruments really wouldn't be simple, given central banks' strong desire, obviously, to maintain complete control over access to and the usage of their own currencies. However, as you rightly say, such coordination is vital to achieving wholesale CBDC's promised benefits of faster, cheaper, and safer payments on a cross-border basis. So in a recent paper, the BIS recognized this, and they offered some new proposals as to how cross-border, cross-currency CBDC payments might flow, terming these arrangements where multiple CBDCs interoperate, multi-CBDC or MCBDC for short. So they proposed three conceptual models for multi-currency cross-border payment systems involving CBDCs, and they termed them compatible, interlinked, and integrated. So compatible MCBDC systems first would basically just leverage commonalities in the areas of technical standards and legal and regulatory regimes to simplify and onboarding and operational processes for independent CBDCs. Now, this is, in my opinion, something of a non-starter at scale, as the coordination required is highly complex, especially without the guidance of supranational frameworks. And the BIS actually highlighted the examples of the common messaging standards of ISO 20022 and the legal harmonization efforts of the single euro payments area to illustrate this, both of which took years. Interlinked MCBDC systems, the idea behind them is that they would benefit from a shared technical interface backed by contractual agreements that enable participants in one constituent system to make payments to those in another, whereas the third, integrated MCBDC, would comprise a single multi-currency system with several CBDCs onboarded onto that single platform. So the idea is that participating central banks would agree on a single rule book, a single set of participation requirements, a single underlying technical infrastructure. Now, the third one there, integrated MCBDC, definitely got the most column inches when it was proposed, but in my opinion, it comes with significant difficulties. And there have been some efforts to make allowance for the difficulties I've already mentioned by quote unquote unbundling the technology stack involved in an integrated MCBDC arrangement. And what this basically means is offering granular control to central banks over sensitive elements like the issuance of a CBDC. And the Monetary Authority of Singapore are the most notable thought leaders in the space. But the problem with that, with this granular control idea, is that, you know, they have to ultimately be built on top of a common platform element. This discretion, this granular control has to ultimately be built on top of a common platform that enables different CBDCs to interoperate. Settlement finality, for example, is a key area in which a common platform approach faces difficulties. As for what that is, settlement finality is a conceptual construct effectively that ensures that transactions will at some point be complete and irrevocable. Now, in a DLT-based payment system, as many proposed MCBDC arrangements, including Monetary Authority of Singapore's, are, settlement finality is derived from the deterministic consensus methodology that underpins it. An integrated MCBDC proponents envisage that this will be part of the common platform that underpins the entire international system, but it's a highly sensitive, highly jurisdiction-specific element of any payment system, and is likely to elicit a strong desire for control from participant central banks, much like issuance itself. So, in my opinion, it's unlikely that the world will land on a single common multi-CBDC settlement platform, mainly due to the sprawling specificities inherent in central banks' desire for control, governance, and oversight over their currencies and how they're used. But interoperability and the ability of different CBDC systems or similar to communicate with one another remains a totally vital, indispensable part of its success. So there are a number of other solutions to this, and many private sector organizations, including Finality, have come up with their own ideas as to how different jurisdictional payment systems leveraging central bank money like digital cash assets can interoperate. And I'm sure we'll talk about that a little bit later.
And I think you touched on something really interesting there, which is this whole debates around the role of the private sector versus the public sector, and private versus public money in the future of digital currency, and how digital money operates. And, you know, even if we look at existing payments infrastructure, some of the stuff that glues it all together is actually provided by private sector initiatives. So CLS or SWIFT, for example, these are not, you know, government initiatives. These are private sector initiatives that have been very successful in providing that infrastructure that glues everything together. And I guess it's been a lot easier for a bunch of private sector firms, so banking and payments providers, to get together and to agree on those common standards than it would a bunch of central banks, for example, which have various other concerns around fiscal and monetary policy and that kind of thing. And what's interesting here as well is that central banks are, I guess, increasingly recognizing that this is a turning point in private versus public money, and trying to think about what they'd like to achieve with that. So there was a recent speech this year by Sir John Cunliffe, one of the governors of the Bank of England, for, I think it was an OMFIF symposium back in May. And he spoke about the distinction between public and private money, and how public money basically was in decline due to the decline in usage of cash. And so the future of CBDC basically was quite fundamental for many central banks, because CBDC being a form of public money, there's an important debate to be had about the extent to which banks want to have that direct ability to control the amount of money in circulation to affect monetary policy through a CBDC, versus having private sector solutions. And from your point of view, how can public and private sector solutions kind of interoperate to, or I don't want to use the word interoperate because that's quite a technical term, but how can they coexist to further progress realization of some of the benefits of CBDC and digital payment systems and digital currencies that we've discussed? And I guess also, how does that lead into what Finality is doing with Finality Global Payments and the Finality payment systems?
So I think, as I've said, there's acceptance from people across industry, across the CBDC community, that there are a number of things that both sides, public and private, have a natural advantage for. And in terms of how Finality, obviously a private sector organisation, can address some of the challenges of that have been presented by, I guess, purely public arrangements around CBDC or initiatives and innovations across interoperability like multi-CBDC, and actually deliver the settlement and cross-border benefits that CBDC arrangements are seeking to achieve. It might help if I give a little bit of an overview of what Finality is doing with Finality Global Payments and our Finality payment systems, and also talk about how that might help deliver many of the proposed benefits of wholesale CBDC arrangements too. So what we're doing is we're developing a solution called Finality Global Payments, or FNGP, which will comprise a series of payment systems in each participating jurisdiction, each overseen by its home central bank. So each one of these is called a Finality payment system, or FNPS. And in those systems, participants use pre-funded settlement balances in an account directly at the central bank to make wholesale payments in real time with near instant settlement. Now, these settlement balances are bankruptcy remote and backed one-to-one by central bank money in the relevant currency, which gives them credit risk characteristics similar to that of central bank money. And we're starting with 5 currencies with a view to adding more as we progress. And on the topic of progress, we were delighted recently when the Bank of England, as you mentioned, published a formal policy statement outlining the eligibility criteria for an omnibus account that will enable innovative payment systems like ours. And everyone at Finality is definitely excited and very grateful to the Bank of England for their clear commitment to ongoing industry innovation. And we expect to fully comply with the bank's policy in delivering novel use cases in peer-to-peer settlement with a new sterling Finality payment system. So back on the topic of interoperability, the challenges that wholesale CBDC arrangements are facing, and particularly the challenges around multi-CBDC arrangements that we discuss, we believe that our series of local Finality payment systems, perhaps most closely aligned with the interlinked model as described by the BIS, the second one I mentioned earlier, we believe that's best placed to address the legal and governance issues that are a primary jurisdiction-specific concern of central banks and regulators while achieving a secure and resilient solution. So in terms of what we've done, we've architected our series of local Finality payment systems to achieve both local oversight and international harmonization. And the issue of cross-border, cross-currency interoperability is thus solved without the need for cooperative management of the payment system across borders, with all the difficulties around jurisdictional specificities that entails. And rather, we're working with each central bank to give them appropriate oversight over their local Finality payment system, each of which is part of a broader coordinated whole, Finality Global Payments, as I said, and is supported by a common interoperability protocol and internationally harmonized jurisdictional rulebooks. So each central bank in the event will retain control over the issuance of its currency, the access criteria that surround it, the settlement finality regulations that ultimately determine how and when transactions become final and irrevocable. Now, it isn't a CBDC arrangement, of course, but many of the proposed benefits of wholesale CBDC arrangements will also be delivered by Finality Global Payments. Think increased efficiency and resilience, real-time settlement with Finality, enhanced support for PVP with reduced settlement risk, and support for existing and emerging DVP use cases in tokenized markets, as we touched on earlier. So I think that, at least in my opinion, speaking as someone who's been at Finality for a while now, I think it's definitely a testament to the power of the idea of public-private collaboration in the space to achieve the aims of a wholesale CBDC. And I definitely believe that both sides are increasingly recognizing the benefits and the virtues of an approach such as that.
So it sounds as though what you're doing there is basically, in the absence of a real-time RTGS capability, you're actually working with the existing payments infrastructure and with central banks to deliver those benefits, but based on the existing infrastructure with the addition of innovative technology and regulatory solutions or on top of that.
Yeah, in a sense. So it's a novel payment system, a novel financial market infrastructure, distributed financial market infrastructure that we are developing. And as I said earlier, many of the problems that exist in the wholesale payment space, and actually one of the central rationales for wholesale CBDC in the first place are the sprawling inefficiencies in the correspondent banking sector. And we believe that our peer-to-peer real-time capability that will be delivered by our payment system will go a significant way to reducing risk and to opening up new opportunities as well as a result of that.
So in all of these models, I guess, whether it's the CBDC model or your Finality Payment Systems model, it sounds as though what's really key to this is this change in payments market structure, this change to who's able to participate directly in payments infrastructure systems, and this potential disintermediation or challenge to the role of intermediaries such as correspondent banks. And if that happens, that could be quite a radical change globally to payments markets infrastructure and to the system of intermediation that we have and things like that. So ultimately, I guess, where do you see this all going? What do you see as the big picture out there? If systems that can disrupt the existing market structures come into being, what's the future of wholesale digital money and payments?
Yeah, it's such an interesting question. I think that the fact of the matter is, the self-evident fact is that financial markets face unprecedented challenges. Things like fragmented and inefficient trade processes, complex and costly risk management, stringent regulatory requirements, liquidity constraints, rapidly reducing margins. Something has to change, and financial market infrastructure is going to play a pivotal role. The topic of our conversation, CBDC, it might be another part of the solution, but in the wholesale space, it's perhaps more likely, for all the reasons that we've mentioned, that the future of wholesale digital money will come about as a result of a collaboration between the public and the private sector, which is going to end up delivering many or all of the purported benefits of wholesale CBDC arrangements. And if this is the case, we at Finality, we definitely believe that we have all of the ingredients necessary for success. The goals of central banks as regards wholesale CBDC initiatives are in direct alignment with ours as regards our Finality payment systems. And likewise, there's significant alignment with the core goals of central banks' RTGS renewal programs too, like increased resilience and enhanced user functionality and stronger risk management too.
Thanks so much, Jake. It's been great having you here today and a really fascinating conversation.
Thanks for having me. Great chat.
Thanks to all our listeners for joining us. You've been listening to the monthly Financial Markets Insights podcast with Jana Pache. In our next show, Jana will be examining the reference data revolution and how firms can use data to leapfrog legacy technology. Subscribe to stay informed of all our future shows, and please do leave a review, as your feedback helps us improve the show as well as increase our audience. See you next time for more Financial Markets Insights.